different levels also of technicality and formats that might change, we might sort of, or given the different levels of technicality, we might change the formats going forward a little bit, but we're going to try to keep a sort of this distinguishing feature of this webinar, which is this idea of a platform to maintain the dialogue between academia and industry, right? So a few words for housekeeping. So the attendees of the webinar, they can use the chat function for technical issues that we can see as host and co-host, but then can use particularly the Q&A box if you have questions, if you want to provide some ideas. And importantly, you can also upvote these by giving them thumbs up, in which case it comes up also higher in our timeline, so to speak, that we can see what you guys are particularly interested in and bring this into the discussion with our speakers. Right? So one other thing is we are recording the seminar, and this video is going to be uploaded to YouTube within a few weeks. So let me now go right into the topic and start introducing our speakers. And we have a great set of really high-profile speakers for this first webinar. On the one hand, we have here Alberto Rossi, who is the Hachigian Family Professor of Finance at Georgetown University. He is also the director of another research center, which is the AI Analytics and Future of Work Initiative. So perfect candidate actually for this topic today, and is also a fellow at the Brookings Institution. He has a PhD in economics from the University of California in San Diego, a Master of Science in Economics from Tilburg University, and the topics that he does research on are particularly related to what we're talking about today. He's discussing fintechs, machine learning, household finance. He's an expert given his publication on robo-advice as well as other applications when it comes to fintech, mutual funds, as well as also mortgages, for example. And then we have our second speaker here as sort of the industry's equivalent, which is Rohit Singh, who is a co-founder and currently the CTO of a startup called martini.ai, which I personally believe is one of the most interesting startups in the AI in the debt market space. So something, if you're interested in that, you should definitely check out. But he's also, and this is something I didn't know before, he's also an assistant professor at Duke University of Biostatistics and Bioinformatics. He has a PhD from MIT, a Master of Science from Stanford University, and a Bachelor of Science from IIT, and all of those in computer science, and was also co-founder and CEO of another company which is called Square Trading, which is a quant hedge fund. So he's the ideal candidate actually to discuss the topics we are interested in. So before we go right into the presentations of Alberto and Rohit, what we would like to do is we would like to get an idea of what your expectations are regarding the seminar today. And what we've done is we have prepared a small poll in which we ask 2 questions, and we're going to reveal the answers basically throughout the webinar whenever the topic, so to speak, fits. So what I'm going to do, I'm going to start the first question, give you a little bit of time, and then move right to the second question to collect some answers, and then we go right into the presentations, okay? So let me start doing this. I'm going to start the first poll, which is called Traditional Financial Models. Do you think traditional financial models are becoming obsolete with the rise of AI and machine learning? And the numbers are coming in. It's amazing to see that we already have 316 attendance overall, which is amazing given that we're doing this for the first time. So thank you everybody for showing up. Yep, like 10 seconds before we have to close the poll. But I think we already have a relatively good representative sample, so to speak. And then we're going to move to the second question immediately. And the question is, what do you believe is the biggest advantage of using AI tools in asset management? So is it improved prediction accuracy? Is it efficiency in processing large data sets, the identification of new investment opportunities, or reducing human bias in decision making? So I'm very interested to see how this works out, and we're going to discuss this during the course of this webinar. Let's take another 10 seconds or so. There'll be a few more answers coming in. Okay, then we're going to close also this poll. So thank you very much for doing this. So I think without any further ado, I think I'm going to hand over to the speakers, and to Alberto. Thank you guys again for doing this. Look forward to your presentation.
Thank you very much, Sasha. Let me share my screen and get started. And by the way, can you see my screen?
Yes.
Perfect. Thank you so much. And Rohit, please feel free to interrupt me whenever you see fit. So what I plan to do today is kind of start from the beginning, right? So the plan of today's talk is to talk about how machine learning is being introduced and it's used in asset management, and what are the potentials. And I'm going to start from the very beginning. So the plan of the talk is to start with the definition of what is machine learning. Then we're going to get into why machine learning is useful in finance and asset management. I'm going to give you some motivation for those people that have studied finance. You see a lot of familiar material there. Then one of the important questions is why is machine learning becoming so popular now? Right? A lot of the techniques we're going to talk about have been around for a while now, but they are exploding. In the interest in machine learning has been exploding over the past 5 to 10 years. And finally, I'm going to present some work of mine that I like to call it kind of a cautionary tale of the promises of machine learning in asset management. What I'll argue is that some of the results that you may see reported in terms of the capabilities of these tools may be potentially a little bit overestimated. And so I'm going to show you why I think that is the case. And I'm going to show you some exercises in terms of using these tools to predict stock returns and form portfolios. Okay, so without further ado, like what is machine learning? Well, machine learning is a subset of artificial intelligence. It is really the process of teaching a computer how to learn for data. What does it do? The idea is that we try to identify patterns and relationships in the training data. For example, I'm going to try to understand what is the relationship between the dividends that a stock pays, or the kind of inventory that it has, and so on and so forth, and the future return. And then we're going to try to use this information to predict future values and future events. Now, the important thing that I would like you to realize is that kind of prediction is crucial in decision making under uncertainty, right? So every time we make a decision without fully known what is going to, if there is any sort of uncertainty, trying to have a good prediction of the success of some sort of outcome is absolutely crucial. And if you think about it, finance is all about decision making under uncertainty. If you are a bank and you're doing credit decisions, effectively what you're going to do is predicting the default of the person that is applying for a loan or a mortgage. If you are doing risk management, you're predicting the probability and the severity of poor scenarios or recessions, for example. If you are
Alberto, may I just jump in very quickly? It's not not a topic related. It's rather, given that we have a couple of more people coming in and joining us, just very briefly, if you would like to, basically, if you have questions, if you want to address questions to both to Alberto as well as Rohit, please use the question and answer functionality, either Q&A or for some, if it's German, it's F&A. This way, we can see exactly what kind of questions you have, and then we can use them and bring them into the discussion, okay? The chat function is not working for these questions answer here this way. Perfect. Thank you so much. And Alberto, sorry for interrupting you.
Thank you. Well, if you are working on financial advice or in fraud detection, effectively what you're doing is trying to predict clients' needs or predicting whether a transaction is fraudulent. And if you're working in asset management, effectively what you're trying to do is to predict stock returns and volatility going forward, because those are the key components you need when it comes to form a portfolio. Now, let me just motivate the use of machine learning in asset management. And let's think about the simplest possible investment decisions that you can think of. And I'm going to refer to this as kind of a time series application predictability of machine learning methods. Suppose that you are in the business of deciding how to allocate your portfolio, and you have two assets you can put your money in. You have a riskless security, you have the T-bills rate, like this is like something that is risk-free. And then you have a risky asset. And imagine that, I'm in the US, so I tend to be America-centric. Suppose it's the S&P 500. And I'm going to denote the return on the S&P 500 as R and the risk-free rate as RF. Suppose you have what we say quadratic utility function. This is just a fancy word for saying that I really like returns, but I do not like risk. I do not like volatility. So effectively, the utility function is telling you that I like kind of a portfolio that gives me higher returns, and at the same time, I do not like to take risk. And what controls the risk is the coefficient of risk aversion that we have. It is called gamma, which is effectively how unhappy you are if your portfolios keeps on going up and down. Now, if you are trying to do this if you're trying to allocate your portfolio effectively, what you need to do is to decide how much of your portfolio, of your wealth, to allocate to the risky asset. Formally, and this is once again kind of a formalization, what we do is we want to maximize our utility function. Our utility function is going to be dependent on the return on the portfolio and the volatility. And effectively, what you do is you want to maximize the expected return, which are going to be the proportion of wealth in the risky asset multiplied by the expected return, the risky asset, plus 1 minus the proportion of wealth in the risky asset that you put in the risk-free rate. And then this is going to be denoting the penalty for risk. Now, if you do this maximization, and this is something that once again you study in any finance course, you'll have that the solution to this is going to be the following. You're going to have that the optimal weight, so the optimal proportion of your wealth that you should allocate into the risky asset is going to be a function of the expected return on the risky asset, in this case, the S&P 500, and on the other hand, you're going to have that at the denominator, you're going to have the risk of the risky asset, and you're going to have the risk aversion coefficient. Now, let's analyze this formula a little bit. What it's basically telling you is that everything else being equal, what you're going to do is you're going to invest more in the risky asset if the expected return on the S&P 500 is high. You're going to increase less in stocks if they are riskier, if the volatility is high. And then this is something that is going to be kind of depending on your kind of characteristics, you're going to put less in stocks if you are more risk averse. But now already by looking at this formula, you'll notice something. what is really crucial here is the expected return on the S&P 500, as well as the volatility. Now, the more precise these predictions are, like ideally, if I know what is going to be the return on the S&P 500 next year, and if that is an accurate prediction, that's going to give me exactly the right proportion of my wealth to allocate into the risky asset. If I do not have a very good prediction of that, then of course, I'm going to have that my portfolio is not going to be very well allocated. And so effectively, you can see already from a very simplest possible example of portfolio optimization I can come up with, you can see that the precision of the expected return forecast that you have is absolutely crucial. And this is why, like, any tool that can help me refine this expectation is going to be very valuable. Now, I can also motivate the use of these tools in the cross-section. I mean, once again, right now I told you that you may decide to allocate more or less into the S&P 500 and the risk-free rate. But another thing that asset managers do is to try to predict which stocks are going to be outperforming the others, right? For example, I want to know whether Apple or Nvidia is going to outperform IBM and Google next year, and so on and so forth. Now, what people have done in quantitative asset management, for example, is to use kind of factor models and what we call factor investing. Effectively, what you do there, you form portfolios of stocks based on a certain characteristics. For example, one of the very popular characteristics is the size factor. That was discovered like decades ago. Effectively, what this is telling you is that kind of stocks with kind of small capitalizations tend to outperform stocks with large capitalizations. At least in the past, that was the case. So now people what tend to do is they take the universe of stocks they may have, which may be like 5,000, 1,000, that it may be, and then you sort them on the basis of this size, the market capitalization. And then what you try to understand is whether those stocks that have small capitalization outperform the one that have high capitalization. Now, of course, if you think about it, you can do, this is what we call single sorted portfolios. You can also work with multiple characteristics. Like, for example, I could think about working with the stocks that have small or large capitalization, as well as book to market ratios that are low or high. Now, of course, suppose you start with 100 stocks, for example. If I form portfolios and I form 10 portfolios, I may have 10 stocks in each portfolios. But if I start working with multiple characteristics, then I'm going to have less and less stocks in these portfolios. And so I'm going to be limited in the number of characteristics I can use whenever I create these factors. Now, but of course, the literature instead found that you have as many as potentially 300 factors. So you have that stocks have been shown to be related, for example, to their book-to-market ratio or to their past returns and many, many other characteristics. So ideally, what you would want to do is to have a tool that allows you to incorporate all this information. So I would want to take a tool that allows me to tell me what is going to be the expected return or the return next year of Apple on the basis of all possible characteristics that I can find regarding Apple. And that may be their accounting ratios, that could be their past returns, that could be news that affect them, and so on and so forth. So all these tools have because there is so much information regarding these stocks that can be exploited, machine learning methods have become more and more popular lately as people started working with them. But now, Rohit, I know that you're in. Go ahead.
Yeah. No, this is really apt. Like, I think your overview of how machine learning helps here, I think, is super interesting. It's kind of as an when I first got my my first job on Wall Street, I remember reading a few books, and Emmanuel Derman had this joke about how most of finance just needs addition, subtraction, multiplication, and division, and most of the time you can get away without division. And I think for finance being a mathematical field, there has historically been a suspicion of fancy math. And even in quant investing, where you have primarily folks with PhDs from quantitative disciplines, there was always, at least historically, a preference for simpler models, what you would call statistics. And I think where the boundary between statistics and machine learning now is kind of blurred. But so people have known about that they can do more sophisticated modeling for a while, but time and time again, at least historically, it has been that simpler models were chosen, maybe because you could understand them, or maybe because the signal to noise ratio is so bad that you need simplicity. That said, you can see this in the hiring patterns of the funds now, that they are explicitly making a focus on hiring folks with basically just machine learning experience. So clearly, and you see this also in sort of the discussion in the marketplace, that in some ways more new machine learning, deep learning has found a place in finance. So what do you think has changed? Why is it that historically sort of there was an emphasis on simpler models, but now at least some folks are finding value in more complex models?
So I think that there is, I like to think about three confluent factors here, right? So I think that, whenever it comes to having kind of good predictions, you have, on the one hand, you need good algorithms, but you also need data and you need computing powers, right? These are kind of the three main ingredients that lead to cheap, better, and faster predictions. Now, if you think about it, so let me start with the algorithms here, right? Really, really big picture once again. The algorithms that people have been considering, you have within artificial intelligence, you have kind of machine learning that really you can kind of think on a very simplified way as prediction based on data. And at a very, very simple level, what we're trying to do is something extremely intuitive, right? So anytime we want to have a predictive model, what we want to have is a outcome variable y. This is what we want to predict. This could be, for example, stock returns. And you may have some features. These are going to be the variables, and I'm going to be kind of, as we go through, I'm going to tell you what are the features and variables we're going to be using in our case, but it can be anything. And then there's going to be f, which is kind of the function of the algorithm linking the x and the y. And then once again, a huge number of real problems are prediction based, right? So let me think something that is not even finance. Like
Alberto, before you continue, because we have a couple of questions already lining up in the chat based on what you guys just discussed, and maybe I choose a few of those. For example, one is we have seen massive volatility in recent markets event. If, as you described, models are following specific logic or models, are there risks of exploitation by market makers?
So this is kind of, when you say risk of exploitation by market makers, I mean, it depends on what kind of the person has in mind, in the sense that, the recent kind of high increase in risk is basically just implying that, if anything, and if you think that some of these new moments of high volatility are different from the ones that you had before, for example, this is kind of a big disruption in the relationship between the stock returns and their characteristics. If anything, you actually imagine that some of the tools that have been trained on a different market regime may not be working as well. So I don't think necessarily that kind of the exploitation by market makers may have an impact associated with the increase in volatility.
No, I agree. I think one thing I'll sort of add to that is a variant of that you can add is, if many folks look at similar things, is there a risk that movements will get more magnified? And that definitely is happening. I mean, the canonical example here, of course, is the flash crash, where everybody decided that this was not a good time to be sitting in the market. And that's where I think careful and thoughtful regulation comes into play, where you don't want to necessarily tell people how to trade, but at the same time, if you're a market maker, we should have obligations about being in the market in some meaningful capacity.
Yep. So let me kind of, once again, any kind of a huge number of real problems are prediction-based. Imagine like you are in a world, if you're doing image recognition, you want to predict whether a certain image is that one of a cat or a dog. What you may do is you may take 1,000 images of cats and dogs. You may take as X's some of these attributes of pixels that compose the pictures, and then you're going to try to come up with a model that predicts whether a certain picture is that of a cat or a dog based on how the pixels of the images look like. Now, the question is, how do you determine how your functional form looks like? Well, you have two things. First of all, you have that there are classes of f functions, and then you're going to have parameters. So you're going to have that depending on the class of function you're working with, you're going to try to change or maximize or minimize or like optimize some of the parameters by minimizing the prediction error, which is effectively the mistake you make in predicting a cat or a dog. Now, what are the tools that people have used? Like, what are the tools that, or what methods people use to determine F? There are many now, right? So you go from for those people that studied statistics, you have up here in the up right corner, you're going to see kind of classical learning, where you see linear regression, polynomial regression. You have ridge and lasso. Then you have more advanced methods, such as ensemble methods, boosting, bagging, and stacking. And then you have more modern techniques that are neural networks, deep learning. And then within this class, you have autoencoders, perceptrons, and so on and so forth. So these are all tools or different tools that are used in order to, depending on what kind of X's and what kind of Y you want to work with, you're going to use different of these methods. But now one thing that I think is very important is the following, is that a key component for good prediction are algorithms, but you also need data and computing power. And computing power is something that we have seen a big kind of improvement in computer efficiencies. This is a plot that I took from The Economist back in 2010. So you can see that there's been a great improvement. But recently, with the advent of GPUs, and everybody that has seen kind of the price of NVIDIA in the market can realize how important they are in terms of speeding computations. We have that computational power has become more and more available. But I think another aspect that is very important is also data storage and costs have gone down. For those people that are as old as me, I mean, maybe some of you remember using floppy disk when you were young. This is something that people don't use anymore. And now you have that storage is becoming very, very cheap. But I think more importantly, one thing that is becoming more prevalent is what we call the digitization of the economy. Now, the economy is becoming digitized in a sense that kind of it's become every actions that you see in the economy is now being recorded. So you start seeing now a lot of alternative data sets that are being kind of popping up. For example, you have digital footprint, or you have all point transactions. And this is kind of huge amount of data that can become useful for predictions. And just to give you a sense of the type of alternative data sets that are being now commonly used in asset management, you're going to have geolocation data where you see the foot traffic of people and trying to understand from that what is going to be potentially the earnings announcements of the various companies that are associated with retail stores. You have email receipts, you have website usages, you have satellite images, you have product reviews, you have flight and shipping trackers. So all this information are now very important for asset managers that can use this information in order to predict what is going to be the earnings that companies are going to announce and base their trade on this type of information. Now, so effectively, going back to your question, Rohit, I think that is the combination of the fact that data has become available, computational power is now available more freely, and you have there is much better understanding of what these machine learning tools are. Now, up to now, go ahead. Yeah,
no, I agree. No, yeah.
Up to now, we kind of I just gave you an introduction to these tools, but let me just get a little bit into nitty-gritty of an example of the use of this machine learning in the cross-section of stock returns. And once again, this is joint work with some co-authors of mine that are at the Wuhan University, University, and Lehigh University. And the title of the paper is Real-Time Machine Learning in the Cross-Section of Stock Returns. You can really also think about it as a cautionary tale of the promises of machine learning in asset management. Now, what is really the motivation of this, right? Now, what is the key task that asset management companies have? They want to identify undervalued companies and overvalued companies, right? So, Warren Buffett will go by hand through the financial statements. Quant companies will automate that, right? So over time, quant shops have figured, and academic have figured out there are hundreds of signals that can be used, right? So if you are an event-driven hedge fund, you're going to think about debt issuance, dividend initiation, change in asset turnover. If you are going to be more of a trend-following hedge funds or asset manager, are going to work with momentum, beta spread, idiosyncratic risk. If you are more of a fundamental hedge fund, you're going to be working instead with some of the fundamental characteristics or valuation type of variables. Now, the question and the debate that goes on in asset management constantly is to try to understand, first of all, whether these signals are useful. And in particular, some of these signals could have been useful in the past, for example, but over time, they may be losing some of their predictive power, right? Going back to what Rohit was saying before, which is very true. Suppose that I have that a certain signal is very good at predicting stocks. What is going to happen over time if other asset managers figure out that this signal is useful? They're going to start using it too. They're going to trade on the basis of it. And then you can expect that this predictability to disappear over time. Now, as most of the in the past, at least people were working with these characteristics, individuals, sometimes working with constructing factor portfolios. Now, recently, what people have done is doing the following. He said, look, we can throw in machine learning method a lot of these variables or these characteristics, right? So I'm going to start with the data. I may have, for every single company, I'm going to have all these characteristics. I'm going to put it into a machine learning algorithm. I'm going to, on the basis of this information, this is going to tell me which stocks are going to have a high expected returns, which are going to have a low expected returns. I'm going to buy the ones with high expected returns, and I'm going to be shorting or ignoring the one with low expected returns. And the general conclusions is that machine learning provides large economic gains to investors, and machine learning yields profitable investment strategies. So the performance tend to be very good. But there is one concern with some of these studies, is that in many cases, they work with signals that were discovered over the years, right? So if I go back in time now and I use, for example, momentum or book to market variables, things that have been worked and used in the past, and I backtest these strategies, I may find that this performance is going to be extremely good, even though maybe I would not have been able to identify these predictors in real time. So in general, the strategies based on these subsequent discovered anomalies cannot be implemented in real time. And then once again, as more and more asset managers work with the same type of information, you should imagine that there's going to be a decline in the performance of these anomalies. And so what we argue in this paper is that some of the results that have been reported may be overestimating the promises of machine learning when it comes to predicting stock returns. So now what do? We take the perspective of an investor that was starting in the 60s and had access to all the accounting variables that companies are forced to publish every year. So these are all like the accruals, the inventories, how many individuals they employ, and so on and so forth. And we create a universe of signals. And this we have 18,000 signals that we can create. These signals, once again, are constructed for financial statement variables using permutational arguments. So I'm going to have in there the dividend price ratio, which is the dividend that the companies pay as divided by the price of the stocks, but I'm going to have also many others that maybe are not at all related. But back in the 60s, I would not have known whether this information was useful or not.
So
now,
when you did this, Alberto, sorry, just a quick question. Why these? Like, I mean, why these predictors and why this combination? Like, for example, why not say price-based signals as well?
Yeah, absolutely. So in the main paper we do is work with fundamental signals. The idea here is that what we wanted to do is kind of put ourselves into the shoes of like fundamental investors that we know since Graham, since the Intelligent Investors book was developed. We know that people have been working with kind of accounting variables, but we also have work that and when we do the analysis also with past returns, like momentum type trades, right? So we use the past 1 month returns, 2 month returns, and so on and so forth, and we go back all the way to maybe the past 2 years returns, or 3 years, up to 10 years returns. And the idea here is that, of course, it's very hard to imagine what an investor would have come up with in real time. But what we wanted to do is to say, look, let's focus on something that is so common and popular, and let's try to think about a universe of signals. But yeah, so the idea for us was to have something that is implementable real time, and sidestepping the issue of kind of look-ahead biases, so of using variables that maybe have been discovered over the years, but that you did not know were useful back in the days. Now, in terms of the baseline setting, so we're going to have, of course, stocks enter and exit our data set. We're going to go from 1963, and we're going to go until June 2019. We're going to do something that is very kind of from a hedge fund perspective, but extremely low frequency. So we think of ourselves as a kind of a mutual fund or an asset manager that trades only once a year. And we also have other results where we do monthly rebalancing, but we want to start something very simple. So we have 170,000 firm year observations. We predict returns every year, and we have 18,000 signals. Now, imagine that this becomes computationally intensive. I mean, some of the results I'm going to show you today actually get estimated relatively quickly, but once you start working, for example, with neural networks, with deep neural networks, you may have that some of these computations may take months, right? So on clusters with 1,000 cores, some of the results took us almost 30 days to compute. But of course, what we did here is to have a fundamental kind of low frequency type of investment or investor in mind. And but Rohit, now you are in the hedge fund world. So how much of a high frequency versus low frequency kind of hedge funds strategies do people usually implement?
I think it depends very much on sort of what the fund, where the fund's business goals are. So I think if you're going to run a larger asset management business where a large part of your revenues will come from, for example, management fees and also incentive fees. That business model works only if you have capacity where you can deploy ideally billions of dollars. And on the other hand, suppose you are running a strategy where it is your prime personal capital and you primarily are looking to make profits on top of that, and you have low risk appetite. So you want to make small amounts of money, but you want to make money most days. And that will change the kind of investment strategy you take. So for example, a $1 billion fund or like tens of $1 billion fund will typically have investing horizons that are longer, simply because you cannot move in and out of a few billions in one stock in a single day easily. While a fund that sort of is just recycling their money every day, they'll be doing higher frequency strategies. And once you go to these multi-strat funds, you start sort of seeing a layering where you would have higher frequency strategies layered on top of lower frequency strategies. And in many ways, the funds differentiate themselves is basically figuring out where in that spectrum they want to sit.
I see. Okay, that's very interesting. Thank you so much. Yeah, so let me show you kind of the baseline results. And once again, if you're interested in the whole paper, you can reach out. I'm very happy to send it to you. But what we do is the baseline implementation you can think of is the following. We're going to take booster regression trees, which is a very standard machine learning methods. And the idea is that what we're going to do, like, why do we choose booster regression trees? Well, ideally, what we want to do in the estimation of the relation between the return of each stock's next period, on the basis of the characteristics, we face several challenges, right? So the relationship between the signals and the returns may be nonlinear. Traditional methods may face what we call the curse of dimensionality, like linear regression methods may struggle in incorporating so much information. Remember, we have 18,000 predictors. So we use BRTs because they exhibit strong performance across fields. They can handle high dimensional data set because they do variable selection and shrinkage, and also they are relatively easy to interpret. Now, let me kind of give you a very quick introduction to what regression trees and booster regression trees are. I'm going to be extremely intuitive, like ignore this first slide. Effectively, like a regression tree, just for completeness, is nothing else but something that can be written in an additive fashion. So I can what we do is we model the dependent variable as a constant in each kind of space or in each area or disjoint state that is spanned by the predictor variables. Now, when I say this, people look at me puzzled. So let me just give you intuitively an idea of what they are. So what the regression trees, what they do is they partition. Suppose I have an x1 and x2 variable, and I want to explain a y variable. And what I'm going to do, I'm going to use partitioning. I'm going to partition the space spanned by x1 and x2 using lines that are kind of parallel to the coordinate axis. And I'm going to do recursive binary partitioning. The idea is that I'm going to try to kind of through exhaustive search, figure out what is the optimal splitting of x1 and x2 variables in such a way that I get the best possible fit on the data I have. And you can see by looking at this plot here is that the advantage of regression trees is that it can capture a lot of the nonlinearities between the data, right? So it may be that if for high value of x1, x2, you're going to have that the expected return is going to be very high, then this is going to be able to capture it. Now, what is the limitation of it is that this is a kind of as I kind of go and split the space span by x1, x2, I'm going to be working with less and less data. So my estimates are going to become less and less precise. So what people tend to do is to use a boosting algorithm on top of it. And the idea of a boosting algorithm, nothing else but fitting iteratively more and more trees in order to kind of get a better fit of the current data that you have. Now, this is kind of gets a little bit technical, but just to give you a sense of the intuition, if I was working only with one boosting iteration, suppose that I had that the true relationship I wanted to explain was this black line. What a linear regression would do is to, of course, be what we say misspecified. It would not be able to capture these nuances. A boosted regression tree would, with one iteration, would split the space spanned by x into two areas and then fit the dependent variable as a constant in each area. With 5 iterations, you can see that I can now capture some of the nuances, and with 1,000 iterations, I can get much better understanding of what the true relationship is. So effectively, you should think about it as a tool that allows you to kind of model the nonlinearities affecting the data that you're working with. Now, what we do here is then very standard. We're going to train our model iteratively. So effectively, every period, I'm going to retrain my model. I'm going to validate the parameters, and I'm going to predict the future. And every next year, I'm going to go back, I'm going to re-estimate my model and predict once again the future. And the idea here is that I'm going to use this tool to predict stock returns, but I'm also going to show you some results that are based on neural networks. Effectively, suppose that I have 1,000 stocks. on the basis of the prediction of this machine learning methods, I'm going to split them into decile. And this is basically, I'm going to have on I'm going to have that the top portfolio is going to contain the one with the highest expected returns, and at the bottom, I'm going to have with the lowest expected returns. And then I'm going to show you the performance of a high minus low portfolio, effectively of a portfolio that buys the stocks with the highest returns and sells the ones with the worst expected returns. Now, let me show you the performance I get if I work with predictors that have been shown or that have been discovered exposed. So I'm going to work with the predictors, the 94 predictors in these academic papers, and then also there's this other exercise I'm going to have with 207 predictors. Now, what I'm going to show you here is the annual performance. With booster regression trees, I'm going to get a 42% annual return. And with neural networks, I'm going to get, once again, depending on the depth, so with 1, 2, all the way to 5 hidden layers, I'm going to get extremely strong performance. These Sharpe ratios are going to be around 2.3 or 2.7. Effectively, what it is telling you is that the predictive ability of these tools, in particular when I work with predictors that have been kind of discovered over the years, is extremely good. Now, if I work with this 207 predictors, which is effectively an extended sample of predictors, I'm going to have even stronger performance. I'm going to have realized returns of 62% per year and Sharpe ratio of 3.7. Now, of course, the problem with some of these results is that I would not have known to use this 94 predictors or these 207 predictors. So let me show you the results that I would get if I use the universe of predictors that I've been working on, this 18,113 signals. What you'll see is something that is much less impressive, right? So you're going to have, and with the booster regression trees, are a 11% annual return and a Sharpe ratio 1.02. Now, if I go and look at this neural network results, you're going to see that they're going to be in line with the boosted regression trees. They're going to be very good, but they're not going to be incredible, right? So you're not going to see 60% annual returns. So what do we kind of conclude for this? Like what we say is that, many of the outstanding results or the amazing results that have been shown do not really account for the fact that signals were discovered over time. And so if you feed this information to this machine learning methods, they're going to be extremely good at detecting them. But it may be not easy for you to feed this information to them. You may not have known to use them when you were working with them in the 80s or the 90s. So this is to say that feature engineering, which is like the choice of signals fed to these machine learning methods, is still very crucial to the performance, right? So the human intuition and the kind of crafting the right kind of signals to the machine learning models, it should be very important. And once again, machine learning are not really a panacea as a method. You should not expect to just apply blindly a standard machine learning tool and find amazing performance. It's still going to require a lot of care and a lot of thought in crafting. And this is something that should be not very surprising if you think about, and if you talk to someone from even OpenAI, those large language models, they are amazing. But if you talk to people that train them, you realize that there is a lot of care and crafting in going through them. Now, just to kind of have a conclusion slide before we get into some of the discussion, once again, machine learning AI tools are becoming very widespread. Asset management is no exception. But I think it's we should really assess their effectiveness carefully across different contexts and over time before deploying them, because some of the results and some of the promise that you may see out there may be a little bit overblown. But thank you so much for listening, and I'm looking forward to the discussion and the comments by Rohit and the audience. Let me stop.
That was great. Yeah, no, I agree with you. I think, and I think the audience is quite perceptive, because the Q&A question where how do we think these will be used? I think one of the big favorites was they'll be used to interpret new data sets. And there was another question, I think, in the Q&A where somebody was saying, what about explainability in terms of these models, right? And my sense is that a lot of the newer models are more powerful in terms of making use of unstructured data and getting structure out of it, and then still putting them together in ways that sort of make sense to you. It's only in some cases, maybe in some high frequency cases, where you can let a completely black box model go to town on things. Otherwise, there is still a fair bit of value in being able to understand what the model is doing.
Okay, then maybe we have a few minutes also to bring in a few of the questions that are now accumulated in the Q&A. So the one which also has the highest number of upvotes, so to speak, is data is one of the big needs for good predictions. What time frame are we looking at to process relevant data for today's and the future market, as the data is always from the past?
So absolutely. So the way we kind of think about the issue is as follows, right? So I mean, every time you are working with a quantitative asset management framework, effectively what you're hoping is the following, right? So you hope that you train the kind of the future returns of the target variable on the basis of some of this X variables. And the idea is that, of course, there is some information or like some advantages in being able to process that kind of information extremely quickly, right? Of course, if you are someone that is able to access some of the signals faster than others, and that's why you have that some of this high frequency hedge funds will have microwave, or kind of they will dig tunnels to have direct feeding information from New York Stock Exchange. But so that is kind of when it comes to speed. When it comes to the relevance of the relationship that you estimate between returns and stock characteristics, there is always inherently this idea of thinking that there is somewhat of a stability, right? So you can imagine that you hope that the kind of the framework, the relationship between the Y and the X variables that you detect with your machine learning methods will remain stable over time. Of course, we know we have tools to detect whether there are structural breaks in the relationship between the Y and the X's. We also have ways to kind of focus much more on the recent past as opposed to the the more distant past. But of course, we always are thinking that there is somewhat of a stability in the relationship you estimate. If you think that you're in a world where kind of there is a completely new, different type, if you think that history doesn't repeat itself at all, then you should not be working with these kind of tools.
Yeah.
Perfect. Rohit, do you have a...
No, I think I broadly agree with what Alberto said. I think just one thing I'll point out is that in many ways, if you look at the bigger quant firms, they have all built out fairly substantial data gathering and data cleaning operations. And a lot of their venture arms, for example, will also invest in companies that do this kind of data prep. So there is a very strong realization in quant investing that your competitive edge might reside in your ability to gather new kinds of data.
Okay, then maybe I think we have more time for a couple of questions. So one is, how are these variables weighted? Are the variables weighted by the algorithm itself through optimization, training, or are they determined by the user?
No. So in particular, whenever, for example, in the context of booster regression trees, the kind of the variable importance, which is effectively how this variable is going to affect the ultimate prediction of the model regarding a certain stock, is going to be determined endogenously through the optimization, the algorithm itself. So of course, you can always have impose, for example, monotonicity constraints. You can impose kind of any sort of relationship that you may be thinking is valuable in the relationship at hand, but that complicates even further the implementation of these algorithms. So for the kind of in the kind of plain vanilla implementation, you should think that you feed the tool the whole set of predictors, and then endogenously the procedures is going to decide which matter the most, which don't matter the most. And this is actually, once again, potentially one of the issues that emerges in financial markets, right? Because effectively what has worked in the past may actually not work in the future, exactly because many other asset managers are working and using exactly the same predictability. So in principle, you may have that something doesn't work in the past starts working in the future, and vice versa. And so this is kind of makes it much more complicated. I always like to make this analogy, like, you know, in the idea that I said before, like, imagine that you have to classify whether a cat or a dog, or whether a picture is of a cat or a dog. Imagine that if you had that the cats and dogs were actively trying to disguise themselves as to being like the cat was trying to disguise himself as a dog and vice versa, right? So if you're working with in that kind of world, it will be much, much harder to predict and to classify images.
Perfect. Okay, I think what we should quickly do is also, let's have a quick look at the poll actually from the beginning, right? And see whether what we've seen here is actually also sort of what you guys would have expected. Let me just release the result from the second question that we were asking actually. So what do you believe is the biggest advantage of it? So Rohit and Alberto, is this sort of what you would have expected, what people are asking or answering?
Well, I mean, I would actually have argued that some of the improved prediction accuracy would have been kind of a key component of the use of these AI tools in asset management. And I think that once again, also the importance of kind of reduce. Well, I guess that probably the first two are the ones that I was expecting people to respond most. But I think people would, I would have expected people to kind of click more on improved prediction accuracy. I don't know if Rohit, you had the same impression or not.
Yeah, I actually I expect that efficiency in processing large data sets, maybe I'll phrase it as not so much efficiency as ability to process large and unstructured data sets.
Capture them, yeah.
So I think that I would have expected to be the highest. I think I don't necessarily think these methods necessarily reduce human bias in decision making any more than previous statistical methods do. I mean, you can override these models just as easily.
Okay, perfect. So let's have a look at the other questions that we were asking, and look at the first question. Okay, so do you think traditional financial models become obsolete? Is this what you would have expected people to respond to?
Yeah, I think this makes sense to me because it's not a either or, it's an and.
Exactly. I think that all these tools are kind of been complementing the ones that people have been working in the past, and then kind of, I think, you know, I think some of the kind of questions that were posed also about the explainability. I mean, there is still a lot of concern. Imagine, like, if you are an asset manager, you have constraints in the sense that you need to explain your strategy. You need to kind of, in order to gather funds, you need to have that what you're doing is somewhat explainable. So having kind of relating everything you do to kind of standard frameworks is always very important.
Yeah, I think, guys, our time is actually up. So let me conclude, and let me briefly sort of hint at also our next webinar. So on October 5, we have our second webinar. Brian Kelly from Yale, as well as Maximilian Stroh from Kroniam Asset Management. They're going to discuss sort of this virtue of complexity. Right, so you see how actually complexity might actually be important in investment to produce higher returns. So it's going to be sort of like a follow-on to what Alberto and Rohit have discussed. So I think now let's probably give both Alberto and Rohit a kind of a virtual big round of applause, because this was really fantastic what you guys have done and sort of what you have shared with us here. What we're going to do going forward, we're going to provide a wrap up of the webinar on LinkedIn in a couple of days. So, and more information as we go along. So please follow us on LinkedIn if you want to receive more information. Thank you guys again, everybody, you, Alberto, Rohit, especially, and of course, everybody in the audience for contributing, for being here. And I hope I see you all on October 8th for our next session. Thank you so much.
Thank you all.
Thank you all. Thank you for connecting. Have a great continuation of your day. Thank you. Bye.
Thank you.
Bye, guys. Thank you.